Mr. Greider, good morning.
Hey, are we on already?
I think
Is it
so.
live?
I
Okay.
think we're live.
Okay. All right. Okay. All right. I just don't see a PowerPoint up or kind of
I'm gonna share my screen right
okay,
now. Let
great.
me get that going.
All right. Probably take a minute or so for everybody to
Yeah.
just log on in here before we begin.
I'm gonna get this going here. About one more minute. How does that look, Mr. Greider?
That looks perfect. I can see it. And I'm glad we kind of do this. It's going to be, I think we kind of condensed it more like 15, 20 minutes because of last webinar. We had a lot of questions, right?
So fun.
So it was fun. So that's what we're here for. You can ask anything you want. You can put it in the chat and we'll get to them at the end on any question you have on anything, the industry in general, any non-Q1 product you want, even though we're going to cover a couple more specific ones. But please ask the questions. We'll try to keep this at 15, 20 minutes. And then we'll go to the Q&A.
Excellent. Okay, well, I will go ahead and get started. Thank you, everybody. Good morning, good afternoon. Thanks for joining us for our February webinar, Deeper Dive into Income Calculation. And it's kind of a little bit misleading. We're a little technical with the income calculation because we're going to talk about non-income too. Mr. Greider, I'll let you handle that in just a minute. But first of all, as always, here's our disclaimer. Thank you in advance for your support and understanding. Again, we have a pretty robust agenda. And like we do each time, everybody will be receiving a copy of this deck and the recording probably tomorrow or the next day. So you will get a copy of that. Let's take a look at our presenters today. Of course, Mr. Greider, thank you so much for joining us again, the SVP of Wholesale Lending. My name is Andrea Formato. I am the Sales Training Manager. And our special guest today is Mr. Robert McDonald. He is one of our highly trained account executives. So David, before we get into it, I have a poll.
Okay.
And forgive me, it's not non-QM related, but I think this will be a good one.
All right. Let's
see.
Can you
see it?
Not yet. I don't see it come up yet.
Hold on. Let me see here.
I love these polls though.
How about
now? I
do
see it. It is up there.
All right, here we go, guys. It's a big game this weekend. Who is going to win the Super Bowl this weekend? Kansas City Chiefs, San Francisco 49ers, or Super Bowl.
What Super Bowl?
I had to put that one in there. I couldn't just have Chiefs or 49ers because not everybody loves the Super Bowl. So we'll take a look. Who do you think? Who do you think is going to win, Mr. Greider?
I'm going to go with the 49ers.
Okay, I'm going to go with the Kansas City Chiefs.
There you go. All right, we have a big Kansas City fan in our organization. He talks about it every meeting, right? And I actually live in Northern California, so everybody around me, especially my family likes 49ers. But I'm originally from Seattle, so I stick with my home team, Seattle Seahawks, since my first 25 years I was up there. So, awesome. But they're not making it. So maybe the next couple.
That's okay. Neither are the San Diego Chargers, or I guess Los Angeles.
Yeah. Right.
Okay. Well, here we go. Well, it looks like the majority of the people are with you. So, I hope that everybody has a safe and fun Super Bowl weekend. So, okay, I'm going to go ahead and continue on to the next slide, Mr. Greider, and I will turn it over to you.
Okay, like Andrea kind of talked about at the beginning, we're looking at income calculations, but it's really a kind of a cash flow. And I look at self-employed, and we get into the bank statement, which is the most common way to approve, the self-employed borrower. It is through the bank statement. So we're going to talk a little bit about that, but even though we'll have another slide on other ways to do it, lots of different ways. So it's really kind of a cash flow, trying to ascertain what their business receipts are, and then apply a common sense expense factor to that so we can get what income, right? So there's lots of theories behind why cash flow of the business banks say work. The biggest reason for me is the reason people go self-employed is that they can look at lowering their tax liability, right? And there's concepts of retained earnings and ways that their accounting system can work. And it doesn't really translate into their tax returns on their qualifications. And then we're going to look at the cash flow process on our investor programs, right? So, and we're going to look at the long-term rents, those that are buy and hold for long term, that have a tenant in there for a while, and plus the newer kind of market that's out there, short-term rentals that came out in the last few years, and how that cash flow is calculated. And there's two different ways to do that that we have with that. Then we're going to look at expanded guidelines on those. So with that, let's just go ahead and take a look at the self-employed, and more particular, the bank statements, right? So the first one I'm going to cover kind of briefly because I think it's even less common than the business bank statement. So we can use personal bank statements. And so it really goes into the theory of accounting principles, and I have a degree in accounting. And it's like when you set up a business, you can be a sole proprietorship, LLC, you kind of stagger it on up on whatever business entity you have. And so the rule kind of is that you have a business account, right? You have all your gross receipts for revenue going in there. You pay all your expenses that you have. You might even have retained earnings in that. And then you transfer money from your business account into your personal, and that's the income you use. So that's the theory of the personal and business bank statements, but there's lots of different accounting methods. So we're able to use 100% of the qualified deposits. And there's reasons I say qualified because, tax refund money going in is not, or you get a loan proceeds, that's not it. But the qualified deposits that look from that business being transferred or deposited, or maybe they just deposit checks into the personal. You can use 100% of that. And since there's no expense factor on those, you got to have a separate business too. You got to demonstrate that expenses are paid in a different account. That's typically the business bank statement. The most common one we see is a business bank statements. So there's lots of reasons. That's where most of the deposits are, and then you can apply an appropriate expense factor to that. We do, and I always recommend, even there's 12 and 24 months, there's no price difference, and so kind of make it easier. Just in general, all you want is the last 12 months, right? We actually have a questionnaire to fill out because we need to kind of take a common sense approach to what those expense factors will be, right? With Home Express, we do have a income desk, so you don't have to spread these out on some Excel form. We have a system for you once you kind of know you're going that direction, right? To go ahead and upload those on our portal, right? And then I'm going to go through the expense factor tiers that we have kind of set, but you're not stopped there. There's other ways to get that done. So let's go to the next slide, kind of show how the portal works, right? So everybody that's approved with us, you have this portal, and I recommend, going through the portal system, especially with all the cybersecurity news, right, coming out. I know that's very important, that you want to make sure all the documents are in a safe, secure. So this is a safe, secure portal where you can log on in and you can upload the self-employed questionnaire and the bank statements, right? And it goes right to the income desk, and that's, within 24 hours you get it. And sometimes it's even, most of the time it's even shorter than that. So that way you can get an idea what the income's going to be, and we're going to go through those steps with you as well. But very important to know that you have the portal, you have access to all this, pricing your loan out, all these different things. So you don't have to send an email. Don't email private information, right, of that borrower over through email. Use the portal for that. So let's take a look at expense factors just quickly, because everybody goes, well, what is that? What does it look like? And these are just general, right? And it's hard to pinpoint exactly what expense factor is, but we go from a kind of a general 15% all the way to 90. And I kind of go over some generalization of what that looks like, right? A 15% would be like a work from home business. They don't have a lot of inventory, not many employees. I always look at, some IT engineer that works from home, maybe their own company, those type of things. Could even be a real estate agent that really doesn't have that much expenses, right? So you can see where that probably makes sense. I'll probably have some expenses, whether it be marketing or some type of equipment that they have, but over that's not a big expense. 30%, and probably more work from home, really not much inventory, some travel expense, and limited employees. Then 50% is probably the most common for what we see at non-QM, limited facilities, limited employees. I put on probably less than 15, but you kind of get a feel for that and what it is. And it's not like, put us in what knowledge you have on the self-employed questionnaire. And when Robert comes on here, that's why I want to have Robert on here, is this this account executive highly trained with us, and he can go through the steps of what he talks to you about on that. Then it goes all the way up to 90%, which is like, could be a big corporation, even though it's owned by or has a proper percentage of ownership, which is 25% to be self-employed. Unlimited employees, you go, man, that's a high expense factor. I go, is it really? I've looked at a lot that have 4 or 5 million on average a month coming in the 90% expense factor, their income could be 400,000 a month that we're using to qualify. Right. So just keep in mind, this is just the general terms. And then I'm going to let Robert kind of talk to you a little bit about that questionnaire and how he talks to his clients directly with loan officers and with you, and how he gets that information up there so we can make this a great, easy experience for you and your borrower.
Hey, thanks, Dave. I really appreciate you and Andre having me on. Absolutely. So in my initial conversation that I'm going to have with the LO, I want to get it as deep as I can into the borrower's business. And so what do they do? How long have they been doing it? And how long have they been self-employed in general? And then, we'll kind of go through the bank statements, take a look at some of, do they have NSFs on there? And then we'll have once we figure out exactly, okay, we've established what kind of business, what kind of statements we're going to use, then I'll have the LO load them on up. But that questionnaire right there really hits on everything I need to know to be able to give them an expense factor on it. So it's really about me and the loan officer knowing what the business is. And so then when we send it in, like I said, it's about 24 hours or so, and then it comes back. And then on the sheet that comes back, I'm going to be able to see what are qualified deposits, what are not qualified deposits right there. And then there's actually a percentage of ownership of the company. We need to be able to look at that as well. And that is on the questionnaire. And then at the bottom there, you're going to be able to see actual notes from the income desk showing, why they came up with that expense factor, questioning any maybe larger deposits. But we're going to know all of that up front. I mean, a lot of my deals are TBDs for people who want to be able to give their borrowers approval letters. And so we've looked at the credit. Now we've looked at the income, addressed any kind of concerns. And now that loan officer can, with a lot of confidence, give their borrower a pre-approval letter and have them go shop. And so it's really about me understanding as much as I can about that borrower's business and then working it from there.
Great, thanks, Robert. And again, we have highly trained account executives. I really mean that. It's like we go through a minimum of 2 weeks, and we have weekly training on all our products. So we're just kind of go over one thing, but they're going to be able to know a lot of our different products to go through this, right? And that interactive approach is very important, that we're all on the same page and there's no surprises and the loan closes on time. And that's what we want to have happen. So let's look at some other ways to prove it. Approve your loan to get that. So maybe an expense factor, you think, hey, the underwriting come up, or saying, hey, we're thinking we're close to 50, and you're saying, no, it's really 40. Well, that's fine, right? We still need a third party, but you can have a tax preparer expense letter done where, hey, I've looked at the last 2 years' taxes, and on that letter, you put a lot of, hey, out of the last 2 years, the expense factor on average has been 40%. Then I go in a little bit more detail on that, because you can knock out a lot of conditions. You can say the length of self-employment could be put on there. Or if it's a purchase, they're going to use money that's in the account that it won't impede ongoing business operations. So you can actually knock out 3 with one condition, with that one piece of paper when you go up to the tax preparer. So then the AEs will go over that with you, just what we'll need on that particular loan. So it makes it real easy for you and your borrower to get that loan closed.
David, before we move on to the next slide, I have another poll.
Awesome. Love the polls.
All right, here we go. Let's go back. Oops. Okay, let me know if you can see that, Mr. Greiner.
It's up. It's
okay,
up.
Here we go, everybody. True or false question. You have to be self-employed a minimum of 4 years to do a loan at Home Express. it looks like almost every single person has done a loan here with us.
I like it. Well,
I love it.
uh,
Yeah, is this pretty common, Mr. Grider? What do you think? What do you think
yeah,
people are going to say
I
here?
do think it's out there because if you look at agency guidelines, it's 2 years, and they're going to say, I bet you it's 2 years. That'd be my guess, right? So they're probably going to put false, and most of them think it needs to be 2 years self-employed.
Okay, I'm going to end this poll right here. Share results.
Yeah,
Okay.
there we go.
All right.
We got a good audience here. Kind of
We got a good audience
knows
here.
what the non-QM guidelines in general out there, right? So, so that's good. But there's a reason why we did that because, it is 2 years. That's the general format on it. But it's time to go over kind of the expanded programs on the self-employed. We do have programs less than 2 years. Right. And these would be managerial supervisory positions that may have been, working W-2, then they start their own business. It has to be longer than a year. Right? That's a requirement. And so there are programs where that does. I actually see, I don't know, at least a dozen or 20 of them that come in every month. And you can see that, people might move or they might be a doctor at Kaiser going through the residency. And hey, I got my client base here. I need to go open up. So 15 months ago, they open up their business and they have a real ramp up of expenses. And then they have their client base up there. You can see that. And they need to move forward with buying a home for their family, right? And it doesn't have to be that. It could be a lot different, but it needs to be a like industry, right? Been in the position. And it's more of a supervisor managerial role where they can function in that. But the other thing on here, multiple business banks, some are allowed, right? So even when you go in the portal, it's going to ask you, if you upload that, do you have another set of bank statements, right? And there's lots of reasons for that. The accounting methods that I described at the beginning is kind of like the ideal, nice and easy. But I'm going to tell you, the accounting methods out there are different for a lot of business owners, and it's even more so today because even with me and some of the self-employed contractors I do business with today, from me personally, I pay them for Venmo or maybe it's PayPal, so they have revenue streams there. Then if it's a bigger job, maybe it's a check that goes in there, and maybe they deposit the Venmo into the personal account. So it's all these ways to ascertain it. We're able to look at that for you, and the whole idea is to try to get what is their business revenue coming in, and then apply appropriate expense factor. And we're able to navigate that for you. Other programs we have some profit and loss only programs. Right? Profit and loss with 3 months. What's the difference between the two? Well, if you have 3 months we can demonstrate where the last 3 months bank statements within 10% of the profit and loss on the revenue side. We're able to extend that LTV all the way to 90 for you on a purchase. We have 1099 programs, right, available. And a 1099 might not even be, for this program into the business bank. It might be full doc. Maybe you're at a business or, I've seen this happen where they're W-2, same company, and they switch their account method. Now you're 1099. And you probably need a few months at least on that so we can demonstrate, but just that type of role change, but really their same income's coming in. Also, we have programs for gratuity earners, right? And I always use the example of a blackjack dealer or a waiter or waitress at a high-end restaurant where they get a bunch of tips over the weekend and they deposit in a personal account. So we take their paycheck stub, their W-2, but also look at the last 12-month bank statement and say, look at all the deposits that come in regularly on this. So it needs to be regular, and trying to ascertain that. You can see that. That's income we could also use. And don't let it scare you if you got one borrower that's not self-employed, they're W-2'd, and the co-borrower is self-employed. That's fine. It's just looking at how we're going to get to the income for that particular borrower. And when you see another thing I add on this, it's there's a lot of ownership that's 50-50, especially if you're married or you're running a business together. If that's the case and those borrowers own 50-50, we use the higher score for qualifying on LTV and the particular rate. So that's important to point out. So with that, let's kind of move on to our investor programs and the cash flow. And I'm going to go at the high level. There's so many webinars on this. I think every kind of gets this program over the last 5 years, right? I remember when we first came out with it. I've been doing non-QM for literally 8 years, or if I may even 9 years. And some of these programs weren't even available, kind of developed over time, and it kind of been adopted, just just as they kind of progress through that. And if you looked at that before this product came out in the non-QM, a lot of these small to medium investors only had really one source to go to, and now it's private money, and they'd be higher rates, maybe be on balloon with points, right? And so this has allowed a lot of small to medium investors get into that market and be able to navigate their finances and their portfolio better. But I'm going to focus more on the debt service coverage ratio program, but you can still qualify on income docs in this or bank statements. It's a little bit better rate if you do that way and it's income qualified. But really, we're looking at the credit of the borrower or borrowers and the cash flow of the property. And on a purchase, again, we're going to use the 1007 or 1025 if it's units. Refinance, you can use either that or the actual rent. So I have a proof of that. And keep in mind, I'm going on this cash flow DSCR, they are business purpose. So the cash out, 51% need to be a minimum use for business purpose, right? And then we're going to look at property types, 1 to 4 units, the calculations for long-term rents versus short-term rents. And I know Robert's going to go a little bit of how he kind of goes through that process with the loan officer as they're going to the borrower to match that up. But long-term rents is a 1-to-1 calculation. That's kind of a big thing. So, but when you go to short-term rents, we take a 20% expense factor for that, for whatever that calculation is. And the theory for that is, or the reason why, is that long-term rents, when you have a renter in there, a lot of that expenses for day-to-day maintenance, utilities, those type of things are paid by the tenant. If it's a short-term rental, that's usually paid by the owner of the property. That's why you have an expense or expense factor applied to it. Someone rents it out 3 days a week, you have to go clean it up, sanitize it, do that thing, and the utilities are generally paid by the property owner, not the tenant. So next slide, I'll bring Robert in here to kind of go how he kind of talks to his contacts and his clients and to give them good advice with their borrower to put them on the right program. So
yeah,
Robert, to you.
Yeah, absolutely, Dave. So again, it's no different than what I was talking about before. Is I want to know as much as I can about the property. If it's a refinance, how long have they owned it? Is it being used for short-term or long-term? Was the property, just purchased and rehab? Now, is there a tenant in there or is it currently vacant right now? We have options for all of that. And then on purchases, again, I want to know as much as I can about the borrower. What's their FICO score? Are they a first-time investor? Are they a first-time home buyer? Making sure that it fits, making sure it doesn't look like it's going to be an owner occupied. And then, we can even go through and do a little research on the market rents, and then if they look tight, go through and find out, if it's a purchase, does the borrower have more money to put down, and then we can run several different scenarios on it. But again, I want to know as much as I can about the property, when it was purchased, or what the intentions are for it as I can, and then make sure that they're credit qualified. And that's it. I mean, there's really not much to these loans. There really aren't. So they're pretty simple. And so it's really about credit and collateral on these. And so yeah, that's really about it.
All right, thanks, Robert. And they are fairly, I guess, simple, but they can get complicated on different property types, right? And so, when you look at it, you got to strategize. And I have, when you look at the intent, right, of a purchase, you may not know, right, that, what it is. What should I do, right? So that's why I put on here down below is like higher density of short-term rentals. I mean, the calculations were better for resort type areas, and you have more data available for the appraiser to go out there, get on the 1007 or the history of that area. Even though there's places where they still rent them out short-term rentals, but the long-term rents might be the way to look at it, right? Because you really don't know after a deal closes. They might say, hey, I'm going to do short-term rentals, and they turn around after 6 months. Long-term rents are, right? So you need to really kind of strategize what to do with that. And that's where you're really connecting with our account executives to kind of strategize how best to get that borrower qualified, use, not use, right? Those type of things, so we kind of know what's happening with that. But lots of different ways to look at these and kind of strategize for the best possible outcome for your borrower. So I've got some expanded items here on our business purpose. Borrowers may have unlimited property zone. I think that's big, right? We can do up to 10 loans at the same time for one borrower, up to 4 million aggregate. And again, since these are business purpose or non-TRID, they can go fast. You can order the appraisal at any time, right? It doesn't follow the same type of rules, right? Again, I always point out cash out, refinance process we use for business purpose. Right now, we're doing DSCR down to 0.75. And again, I don't think there is such thing as a no DSCR because you're going to have some on there, but there are some programs coming out where it can be below that. Minimum FICO to get in is 620. Will you have the ability with us so that borrower can invest in a business entity? Even though we're qualifying off, we're in the residential sector, we're calling off the credit of the borrower or borrowers, right? I know a lot that say, I want to keep this in an LLC for liability reasons, right? So they own 8 properties. Sometimes they want 8, they have 8 different LLCs, they put it in, and that's fine. We have that ability with us to kind of navigate that. So we make sure the vesting goes correctly for them in their business entity. And also, if I could last webinar, states are available where you can lend in without an NMLS on the business purpose. So if you kind of see that, want to expand on that, get with our account executive. They'll give you the states that you can actually do these loans without being NMLS required. Property types, again, kind of with this, we've kind of expanded to condo hotels. We can even look at rural at a lower LTV. And again, I say we're no remote. I mean, because when you look at properties, it's about marketability and if the property is legal. The more remote you get, the less marketability it has on it for a tenant. So kind of be careful of that. Other things too, listed for sale in the last 6-12 months, right? We can look at those as well. Maybe they change their mind to say, hey, it's probably not opportune time to sell it. I'm going to keep a tenant in there. We do require a prepayment penalty on those if that case, right? Recently purchased and rehab, we can look at those. I'm not saying we're going to do these cash out transaction, but we could actually use a new appraised value on a rate and term. Maybe they had to get into the property using private money. It wasn't lendable at that time. They rehabbed it, fixed it up, and now they want to get out of that hard money loan. That is great. Let us take a look at that. We're not going to look at a deal where they purchased it for $100,000, didn't really know documented improvements, and now the property they're saying is worth $800,000. They want cash out. That's really kind of difficult. And again, it goes on the principle of like on marketability, right? The acquisition value, like within the last 6 months, the best comp you have is the property itself, right? That's what it's sold for. But they can document the improvements they made. That's a little different thing. We can take a look at that as well. But we don't have to wait for the full 6 months on like a rate and terms and those type of things. Questions? I know we went like 40 minutes last time on questions, and I love to take those.
That was fun last time. Thanks, David. We do have a couple questions, and they're kind of around DSCR. So the first one is, do we need reserves on DSCR?
Depends on the LTV, right? So over 65% LTV, you do need 6 months reserves. Cash out can be used for reserves, right? And again, we're a common sense lender. These are our own guidelines. We fund our own money. Maybe they're a little bit short, maybe that. Tell us the story, right? That's the big thing. Here's what we're trying to accomplish. What should they have? And you bring that into your account executive. Hey, there's lots of ways to get deals done that you might not think we could do. We like taking those deals that might be a little bit stretched with, okay, what can we do on this? But I mean, reserves is a big deal, right? I look at this, even if it's not required, right? We got to think about industry and really care about these potential borrowers, right? Let's say something happens, a medical thing, they're out of work for a couple of weeks, or tenant goes and says, hey, I'm moving out. They don't pay them. I mean, those are factors you need to look at. You don't want to put a borrower in a bad position where they're just on the ride. If anything happens in their life that, hey, they may not be able to make their payments. We don't want to do that.
Thanks, David. Kind of another question that came in, sort of a follow-up for DSCR. Are the reserves for the subject property only?
Yes, it is. That is a good question. That's a little bit different than agency rules or jumbo prime, is that our reserve requirements is for the subject property only. And that's why I say you don't really need it. That's why I say I'm probably more of a proponent, even if it's not required, at least know what they have access to, right? And I think that's one area we could do a better job on taking our applications and kind of just ask them what kind of other source they have. They have a retirement planning, right? 401k, those type of things. That's also tells you that they're financially looking ahead in their lives and making themselves go forward. It's not just, hey, got to get it done and this is why, and maybe might have a propensity that if something happened to them, they might struggle making the payment, affect their credit. We want to do good loans to good people that don't fit the traditional mold of financing at the bank or in the agency. That's what these programs are for.
Makes sense, David. A couple more that I think I heard Robert talk about, but just to reiterate, can a first-time investor do a DSCR loan?
Yes, we do have programs for first-time investors. And again, we got to take a common sense approach. Even though I say, hey, first-time investors, we can do those, and all of a sudden it comes in, you got to look at the intent and the area it's at. So I said I'm in Northern California, right? So I'm more inland than the Bay Area. But let's say you have a doctor that's in San Francisco, San Jose, Menlo Park, and they're going, man, I really don't want to buy a property here, but I have all these assets. I got my stocks, bonds. I'd like to get into real estate. I think to hedge that. Then they buy inland, maybe Modesto or someplace like that. Say I'm going to start buying that, but they're first time, right? That probably makes sense, right? Okay, we know that. So really look at it. If it's buying a property right next to where they work within 5 miles, they don't own a property, then you might have some occupancy concerns. So that's really what you look at. It's more of a common sense approach.
Excellent, thank you. And on the DSCR, is the prepayment penalty 3 years?
On our rate sheets that we have out there, the pricing is based on 3 years, but we do have ability to have, believe it or not, a zero prepay all the way up to 5 years, right? And then that 3-year prepay, we even have a staggered prepay, right? So it's not like it can go down over time. And so those are the things when you talk to your account executive, what is best for the borrower, right? I think a lot of people have taken the step down or kind of staircase prepayment penalty because they're going to hang on for a year, but want to exit straight or later on and at a better rate today. When you go to zero, it may have some cost to it because we're not a bridge. These aren't meant to be a bridge loan, right? So bridge loans, typically you got to pay points. There's an exit strategy at the end. Don't use this as a bridge loan, right? Kind of go forward with what their intent is, right?
Excellent. Thanks, David. Here's one that I think I heard Robert mention in his part. Can I live in a property bought with a DSCR loan?
That's pretty difficult, right? Because you living in it, therefore it's a consumer purpose loan, right? And that needs to be afforded TRID, right? Not to say that I know a lot of people that bought homes and rent out part of it, right? But since you're living there, I got to afford TRID, and that'd be a consumer purpose loan.
Thank you. Kind of switching gears a bit, do we have any asset for income programs?
We do have assets. Again, I've seen a lot of those start to come up. So I'll just kind of briefly go over asset programs. We have Asset in Full, which we call Asset Express. So this is a non-DTI program. So if you're under Dodd-Frank and how companies have to kind of develop their guidelines on ATR, you can use income or assets or a combination of the both, right? So if you have enough assets to cover our loan balance, day it closes at 125% of that loan balance, there's not even a DTI calculation. They don't even have to put their job or income on it. That's a program we have. Also can take assets that we have, that they have, and use that as additional income or asset depletion, which we divide the qualified assets by 60 months, and you can add that on a 1003, and that might help you get from 55 DTI to 40, right? And that is done all the time. That's a great question.
Excellent, thank you. I think that is all that we have. So great questions. I'll go ahead and I will move on. Do you want to talk about next month's webinar?
Well, we have this. I thought we were going over topics. So I really think when I've looked at, probably more so the last 6 months, it's been a lot of chatter about cybersecurity, right? And I think it'd be important for us to talk about that in our new portal. It kind of has the same feel it is. We probably have what 15-20% of our sales staff has the new portal they're running on right now, but we're gonna have everybody on it in this month. And just to go over that and really talk about that, right? I've known some people that other companies that had some cyber security attacks. I mean, First American went down what in December. I'm going, this is a real thing where we need to take it. So we have a big initiative to make sure you know how to deliver documents to us securely, and that's through this portal. And you can interface with that. You can talk on the phone to all that. You can upload the credit right on the secure portal. You can view it. The bank statements you yourself can upload. So we're not sending out this non-public information around by email, and that's a pretty much big initiative that we have. And we're hoping that you kind of adopt that as well when we make sure our industry is taken care of. We're a big target since we have a lot of data on our residential loan applications and bank statements and all these income docs, where we want to make sure we're doing our job of really trying to make this a secure going forward.
Excellent.
So we're going to go over
I'm very
that.
excited about that.
Yeah, I am
Great.
too.
Thanks, David. Okay, I will wrap it up here. So thanks everybody for joining again. If you are already an approved broker with us, thank you very much. We appreciate your partnership. If you're not an approved broker with us, it's very easy to become an approved broker. You can fill out the application directly on our website, and you can get your login credentials within 24 to 48 hours. It's a very easy process. Or if you'd prefer, you can contact Mr. Grider. So as we always do, David loves getting phone calls. Here is his email information. Here is his phone number. Feel free to reach out to him as well. But again, everybody, thank you so much for your time today. You will be receiving a copy of this deck as well as the recording, but reach out to us if you have any additional questions. And thank you, Robert, for being our special guest today. Super fun. Thanks, Mr. Grider, for your time as always. I hope everybody has a great February, and we'll see you next month. Thanks, everybody. Bye-bye.